Welcome back to the next in our series of videos on welcome to the introduction to financial services industry. This section is to discuss fixed income part 2. So the last one we talked was a little bit long, but we talked about part 1 on fixed income products. Here we're going to talk about part 2 of fixed income products. So I'll give our quick disclaimer. I'm going to review kind of what I said in the earlier one, which is, most of fixed income products we're talking about are bonds. Bonds have a principal, which is usually the face amount, but sometimes not the face amount. But you have a face amount and you have a principal. Investors get paid interest or coupons, and sometimes instead of paying coupons, the principal is less than the face amount, and they're paid the interest as accumulated towards the maturity of the full face amount of the security. And bond values, as I described, are very difficult to calculate because they're constantly changing as dividends are paid out over a period of the life of the bond. Okay. So I already went through all this, so you're familiar. So what we're going to talk quick about is corporate bonds. So this section is going to deal just with corporate bonds and what they're about. So I love this certificate. This is an old certificate. It's this is from Sears and Roebuck. It's a Sears and Roebuck stock certificate where this is how many shares. What is it? It's I guess 25,000 shares. I guess it is. But this is pays. Actually, this is actually a bad example because it's actually a debenture. But the idea of corporate bonds here is, let's say Sears and Roebuck. Corporations need to borrow money, right? So let's say Sears and Roebuck needs to buy money to build new stores, buy trucks, build warehouses, expand their business. So what they will do, corporations will borrow money. They'll borrow money by issuing bonds and promising to pay back an interest. So that's what the corporate bonds are. And really, corporations absolutely need this as an instrument because they need this as a tool for borrowing money so that they can expand their businesses, right? So it's a debt security issued by a corporation. It's sold as an investment. Now the backing for the bond is usually the payment ability of the company, which is typically money to be earned in the future. So the backing for a corporate bond is the fact the corporation thinks that they're going to make money, make profits. So if they're going to issue a bond and they're going to pay a certain interest rate, they think that they're going to borrow that money for the bond and they're going to, like I said, open new stores, buy some new real estate, get some more warehouses, add some more employees. They're going to take that money and they feel that they're going to increase their business, increase their revenue, increase their profits, and they're going to use that increased revenue to pay off this bond. So the bondholders are going to be paid off based upon the revenue that the corporation's going to earn. That's the backing. So a very successful, profitable company is going to be of a lower risk for corporate bonds. A company that maybe is a little bit on the edge, that's not as profitable, their bonds are going to be a little bit higher risk. But the point is, the corporate bond is being issued against future money that the company thinks they're going to make. And by the way, the company's assets are being used as the collateral to the bonds. Corporate bonds are considered higher risk than government bonds. Why? Because Corporations are higher risk than governments because more corporations go out of business than governments. If governments need money, they just should generate taxes. So a government can just generate taxes, whereas a corporation has to generate revenue, or they have to sell off assets, right? So a corporation backs their corporate bonds. Corporate bonds are backed by the assets of the company, any patents they hold, any assets they own, and whereas governments can generate taxes. So corporate bonds are considered to be a little bit higher risk than some other types of bonds. But as a result, they'll usually pay higher interest, right? Corporate bonds are issued in blocks of $1,000 par, right? So you're not going to have a corporate bond issued for $500 or $100. Corporate bonds are now today in the world today. They're usually can be issued in blocks of $1,000, right? So you might have $10,000 in corporate bonds or $1,000 in corporate bonds, but you're not going to have a $500 corporate bond. That's normally the way they're going to be structured. I mean, there could be exceptions, but that's normal. Corporate bonds can also have call provisions to allow early repayment of if the prevailing rates change. Now, this is very important. These are called callability. So a bond can have a contingency built into it where the issuer, the corporation, let's say it's Sears. Let's say Sears issues a bond and they're paying 8%. So they're going to issue a bond and pay 8%. But they might have a provision that built in that says the company has the right to call back any bonds if they want. So let's say you put up your $10,000 and you get a corporate bond from Sears at 8%, and you're happy because you're getting paid 8% on the bond. But let's say the interest rates drop, they go down. And now Sears can borrow money at 6%. So Sears sits back and the board of directors of Sears says, well, why are we paying these bonds at 8%? Let's pay them off. Let's bring everybody up to date, pay them what we owe them up to today, and call back the bonds. And then we'll go out, we'll borrow the money someplace else for 6%. So that's what callability is. So let's say you've got a bond and you think you're holding a 10-year bond at 8%, and you're so happy you're going to get paid 8% for the next 10 years. Corporation, if interest rates go down, could call back that bond. Yes, they will pay you what they owe you. They will pay you back your principal, and they will pay you the interest payments they owe you up to that date at the full 8%. But they're going to call back the bond, and you're not going to make any further payments. You're going to get your money back. And then what they'll do is they'll go out and they'll issue another bond at 6% or 5% or 4%. They'll borrow the money someplace else. So think of it like this. You lent them money at 8%. When they can get a better deal, they call back that loan. They pay you what they owe you, and they borrow the money someplace else at 6% or 5% or 4%. That's what callability is. Now, not all bonds are callable, but this is very important when investors, institutional investors, are looking at bonds. They want to know if they're callable. There's also what's called contingent callable bonds, but we'll talk about them later. Corporate debt matures in less than 1 year is typically called commercial paper. So when there's a corporate bond and it matures in 12 months or 6 months, they don't call it a corporate bond. They call it commercial paper. That's a typical term. So short-term bonds, short-term corporate bonds, where a company says or corporation says, hey, we want to borrow money, but we only want to borrow it over the next 12 months. They're going to issue those securities, but they're going to call that commercial paper. It's still a type of corporate debt, but it's not thought of like a regular corporate bond. Where normally you have a corporate bond that goes over several years. Commercial paper is just less than a year. Now, then there's what we call, there's another type of fixed income product, and it's called money markets or bank certificates or CDs. And you'll see I have one here, Pinnacle Securities. This is basically where a bank says to you, hey, give me your cash, give me your money, and give me your money for the next 6 months, and we're going to invest it, and I will pay you such and such return on your CD over the next 6 months. So it's a short-term investment. It's a short-term way for banks. What the bank will do is the bank will give you, let's say the bank is giving you 6%. They're going to go then take your cash and they're going to see if they can invest it someplace else and get 8%, 9%, 10%, right? So basically, they're a savings certificate entitling the bearer to receive a certain interest. A CD bears a maturity date, a specified interest rate, and can be issued in any denomination. So banks issue these. Again, banks only make money if they can loan out money. So banks are gonna basically issue CDs to raise money, and then what they're going to do is they're going to invest that money. Maybe we're going to do it in local business loans, in a small community or other plays. So again, that's what bank CDs are. CDs are generally issued by commercial banks and are insured by the FDIC. So very low risk. Your money that you have in a CD, it is tied up for the term of the investment, right? So it's not like a checking account where you put the money in and you can take the money out tomorrow. When you put that money in the CD, it has to stay in that CD until the CD matures. But it is federally insured, so you don't have to worry that the bank's going to go out of business or the president of the bank is going to run off to South America with his secretary. These are secure, safe investments. But it gives the banks the way to raise money that they can use and they can pump into a very good instrument for pumping money for small local banks to pump money into the local communities. Okay, so the term CD generally refers for anything from up to 1 month to 5 years. I don't really see many CDs that go out 5 years, but generally they're in the shorter terms of several months. But I guess they could go up 5 years. It is a time deposit that restricts the holder from withdrawing the funds on demand, although it's still possible to withdraw the money. This action will incur a penalty. So when you put your money into a CD, a bank CD, it is going to, you could get the money out before the CD hits maturity, but you're going to pay penalties. You're going to lose money on the penalties. A good example of somebody who does a lot of CDs is USAA. USAA, this is a big part of their business. USAA helps their customers invest in CDs. That's a very popular investment with them. I'm not endorsing USAA. I'm not saying anything negative about it. I'm just making note that that's a big part of their business. CDs are actually really, if you have a block of money that you want to park it someplace safe and get a short-term investment, that's one of many instruments that's very good for investors. Again, that's this section. If you have any questions on this section, which was corporate bonds and commercial paper, money markets and CDs, please contact me at the address listed here. And with that, thank you very much, and I'll see you on the next video.